An uptrend is defined as a series of higher highs and higher lows. As long as this pattern remains intact, the uptrend is valid, and when lower highs and lower lows are introduced, it forms the basis for one of the most notorious reversal patterns, the head and shoulders. In today's video, I will show you my own way to analyze and trade this old school pattern, and I will share exactly what to do to increase your winning rate when trading this formation. The head and shoulders is a bearish reversal pattern that consists of three main parts: the left shoulder, the head, and the right shoulder. The pattern begins as a series of higher highs and higher lows, the classic definition of an uptrend. That sequence is altered when a low point is formed that has the same approximate value as the previous low. The left shoulder and the head of the pattern are now fully formed. This is the first sign that a change in trend may be imminent. The price rallies from this point, but instead of resuming the sequence of higher highs, a lower high occurs. Often, this lower high is similar in value to a prior high point that is now the peak of the left shoulder. Then the price slides back to the previous low for a third time, forming the right shoulder. The pattern is now complete. The three lows should be similar in value and represent an area of horizontal support. A line is drawn across the three lows, and this is known as the neckline of the pattern. Think of the head and shoulders pattern as the transition point between two opposing trends. The left side of the pattern represents the end of the uptrend, the final higher high, and the right side of the pattern represents the beginning of the downtrend, the first lower high. So keep in mind that the location of the reversal pattern is critical, and that the pattern is defined by the price action that precedes it. Most novice traders only use price action to analyze and trade the pattern, but I like to analyze market volume when I'm spotting a possible head and shoulders. Volume is an important consideration of the head and shoulders pattern. If a higher high occurs on expanding volume, this is considered healthy and normal in an uptrend. However, in an ideal scenario, the head and shoulders pattern sees volume diminish on each successive peak. The higher high that forms the peak of the head should ideally occur on lower volume than the previous high, which formed the left shoulder. Volume should diminish further on the third peak, as the right shoulder forms. This demonstrates a lack of enthusiasm on the part of the bulls, who are losing their will to continue buying at higher prices. If and when the neckline breaks, that break should occur on high volume. This example shows how volume decreased as the pattern forms. First we have a rally, but the rally came to an end, which also represented the peak of the head and shoulders pattern. See that in general, the volume beneath the head and shoulders is low compared to the rally that preceded it. In fact, volume is extremely low on this bounce from the neckline. Once the neckline was broken, volume began to increase as the price moved lower. The neckline is the focal point for traders who wish to use this pattern to their advantage. Since the price advances upward from the neckline on several occasions during the formation of any head and shoulders pattern, we can assume that some traders were buying at that level. What can be said of those who took long positions on the neckline and are still in the trade? We know that those buyers, along with any buyers who entered at higher prices and are also still in the trade, will be holding losing positions if the neckline should break. These losing traders will be motivated to sell, which should help push the price lower. Also, aggressive traders will close long positions and sell short as the price breaks through the neckline, without waiting to see if the price will close below the neckline. Other traders, wishing to avoid a false break, will allow the price to close below the neckline before initiating a short position. This is considered a safer method of entry. But it isn't always feasible because the price can move sharply once the breaks occurs. A trader who waits for the price to close below support may find the price has moved far below the neckline, creating a less than ideal risk-reward scenario. A more conservative entry approach for a short trade would be to wait for the price to close below the neckline and then place an order to sell short just below the neckline. The assumption is that the neckline, which was the major support level on the pattern, should now act as a resistance should the price manage to rally back to that level. There is no guarantee that the price will rally back to the neckline, but if it does, the trader is now presented with a second chance to sell at resistance within the context of a head and shoulders breakdown. In this example, we found the head and shoulders pattern and price broke through the neckline support. This break of the neckline was the first opportunity to sell. If we extend the neckline to the right, we see the price rallied into the neckline's extension. The neckline, formerly support, now acts as resistance, and the price advance is stopped at that point. For traders who missed the initial breakdown, the rally to the neckline is the second chance to sell. If a head and shoulders breakdown occurs, how far should we expect the price to fall? The size of this structure holds a direct relationship with the potential target for the trade. Therefore, it's important to understand how to measure the size of the head and shoulders pattern. To do so, you need to take the distance between the high of the head and the neckline. Now that you have the size of your head and shoulders pattern on the chart, you should apply this length downwards, starting from the initial breakout through the neckline. This is the price move you should expect when trading the head and shoulders setup. The head and shoulders trade setup should be used in conjunction with the stop loss order. The head and shoulders pattern, like any other pattern, doesn't provide a 100% success rate, so you must protect your trading account in case price moves against you. The optimal place for your stop loss order is above the second shoulder on your chart, so when you short the market after a head and shoulders breakout signal, you place the stop above the third top of the pattern. Don't expect to find the perfect head and shoulders pattern every time. You must be flexible, and in real time you'll find many variations of this formation. A fairly common variation on this pattern is one that contains multiple head and shoulders. In some cases, the head and shoulders pattern forms as it normally does, but fails to break the neckline. Instead, it forms a second or even a third right shoulder. The fact that this version of the pattern has multiple right shoulders doesn't invalidate its meaning. Here's an interesting example. We have a huge head and shoulders pattern. At the time of its formation, the left shoulder appeared as a possible double top. The head also looks similar to a double top, as does the original right shoulder. Instead of breaking the neckline after the formation of the right shoulder, the pattern forms two additional right shoulders before finally breaking down below the neckline. There are a few key insights I want to share with you. Think of this as rules to follow when trading the head and shoulders pattern. First, the pattern must form after an extended move higher. It can only be a bearish reversal pattern if it forms after an extended move higher. One way to double check is to make sure there are no immediate swing highs to the left of the formation. In this example, notice all the white space to the left. That's what you want to see when trading any bearish reversal patterns. Second rule, neither shoulder can be above the head. The head should always stick out above the left and the right shoulders, and while there is no exact rule for the distance, it should be evident from a quick glance. Third rule, the neckline should be horizontal or ascending, but never descending. If you find the head and shoulders when the neckline moves from the top left to the bottom right, you may want to stay on the sidelines. It's a sign of weak reversal pattern. And while you may still enjoy a favorable outcome, the odds aren't in your favor. Instead, you want to see an ascending neckline. In my experience, the steeper the angle of the neckline, the more aggressive the breakout and reversal is likely to be. Number 4. The left and right shoulder overlap to some degree. Each shoulder must share a portion of the same horizontal plane. They don't need to overlap entirely, but they do need to share a portion of the highlighted area. If you find a price structure that doesn't fit the description, you could add it to your watch list, but it isn't technically a head and shoulders. And here's how I personally validate a head and shoulders pattern. If you followed my channel before, you know that I'm a big fan of divergences. A divergence occurs when an indicator and the price of an asset are heading in the opposite directions. A negative divergence happens when the price of an asset is in an uptrend and the major indicator, in this case the RSI, heads downward. Often, you will see a divergence pattern between the left shoulder and the head, like in this example. This is a powerful leading signal, and a divergence could add fuel to a potential breakout below the neckline. Also, you could have a hidden divergence between the head and the right shoulder, meaning a lower high between the head and the right shoulder, and a higher high on the indicator. Here are several examples of valid signals. As always, if you learned something new and found value, leave us a like to show support, subscribe to our channel and hit the bell icon to stay in touch when we release new videos. Until next time.